Okay, folks, we're going to go ahead and get started here. We do have a couple more people coming in, but we want to get Jon going here. It's a couple minutes past the hour. So, first of all, my name is Jeff Clark. I'm a regional director here with GoldenCare USA. I'll be just introducing you to Jon Thomas very shortly here, turning it over to him. I did want to just say a quick thank you. I mean, we've got almost 45, 47 people on here now, financial and insurance professionals that have taken the time to spend some time training with us. And I just want to sincerely thank you for that. And again, I don't want to take too much time here. We'll get Jon rolling. Jon Thomas with Securian Life. He's going to be going over the SecureCare Universal Life product. Have a nice product. Tell you what, as far as the industry, as little as I know about comparing them, I know Securian is thought about very highly, largely because of that cash benefit portion, which we're always a big fan of here in long-term care. So, without too much ado here, I'm going to turn you over to Jon. And Jon, I assume you can hear us. And Jon Thomas, go ahead and take it away.
Thank you, Jeff. Really appreciate that. Appreciate that introduction, and appreciate all of you that have joined this morning. Good morning to you all. Again, I'm Jon Thomas. I'm a sales director with Securian Financial. You know, as I'm getting started, I do want to thank folks at GoldenCare as well for having me on to the call this morning. You know, it's a pleasure to be able to talk with you all. And you know, for those of you, I know many of you work with GoldenCare regularly, but if you haven't, the folks there are fantastic. Jeff and Lynn and other folks that you may work with are great folks, very knowledgeable. So I would encourage you to reach out and ask and pepper them with questions. I know they're knowledgeable and can answer your questions.
Hey,
but
Jon, one quick thing here too. Jon, I'm sorry, as far as questions, folks, you can type them in. What I'm probably going to do here is, you know, maybe even like halfway through or something, we can read them. At the end, I guess I'd like to go ahead and just read the questions to you, Jon, and then just have you kind of answer them at the end. That's all right.
Oh, that's great. Please do. And,
okay,
and Jeff,
perfect.
If you
go
have
ahead.
questions as we go, or anything I say doesn't quite make sense, feel free to jump in and ask those questions.
Okay.
Or if there's a timely question in the box, feel free to interrupt me. We can have a bit of a
Thank
conversation
you.
as we go. Absolutely.
Yes, perfect. Okay, go ahead.
Yes, and as far as our time today, I'd love to keep it about 35 minutes or so, and then leave time for questions, 10, 15 minutes or so of questions towards the end of the call. But I've been with Securian about a year. I'm new to Securian. I was with another insurance carrier for about a decade, so I've been in the industry for 10, 11 years, and long-term care is a passion of mine, and really the idea of elder care planning and how we're planning for this generation as they age and need our care. It's something that's impacted my family personally. I know it's probably impacted many of your families, and we need additional resources to address and really mitigate the risk and cost of elder care in our society, right? And I know many of you are long-term care professionals and are very passionate and aware of the need to plan for long-term care. So I'm not going to talk a ton about the need and planning, more about Securian's product and how we address and mitigate this risk. So our time today, a company update, who we are, and some of the basics of the product, why it's unique, and in with some sales ideas and concepts that I hope you take away and have some clients in mind, folks that you see would be a good fit for this type of product or idea. So who is Securian Financial? And Jeff and I were talking a little bit at the beginning of the call about who we are as a company. Securian Financial is Minnesota Life Insurance Company. You've probably heard of Minnesota Life, maybe the old Minnesota Mutual, as we used to go by. We are one and the same. Securian Financial has actually been the parent company of Minnesota Life or Minnesota Mutual for the past several decades. But as we have grown as a company, we felt there was a need to rebrand as a one company that sounded more global, sounded more national, and didn't quite have the regional name of Minnesota Life. So we are Minnesota Life. Our policies are still written on Minnesota Life paper, if that's maybe a question you have. But we've just rebranded under the Securian umbrella to have more of a national presence and national brand. So that's really the change in name, to give you some background there. But Minnesota Life is the 8th largest insurance company in the nation as of this past year. close to $6 billion in benefits paid to customers in 2018. Almost 80 billion assets under management, $1 trillion of life insurance in force, and 19 million customers across the U.S. So we're a sizable company, and this isn't something to brag about the size of the company, but to give you a sense of who we are and the size of the company so that you have faith that we will be around to deliver on the promises in the policies that you write, right? That is always a concern when you're writing a product or a policy. You want to know that the company is sizable and has strength and stability and will deliver on these promises. Securian is one of the best, and as someone that left the previous insurance carrier to join Securian, I truly believe that. They have incredibly high ratings. A Comdex of 95. If you're familiar with a Comdex ranking, it is in the top 5% of Comdex rankings for companies. And so incredibly stable and strong company. We are a mutual company or mutually held, which really means that policy holders have some ownership. When you get a policy from Minnesota Life, Securian, you become a small owner in the company and have a voice in the company. And so we manage our company for the benefit of our policyholders. We're not public. We're not beholden to stock owners. And so we have the ability to be more conservative in how we manage our finances. And so as this strong, stable company, we will be around to deliver all these promises in the future. All right, so a long-term care solution, hybrid. For those of you that are very familiar with long-term care products, you may know that really the three different type of products, and I will talk a little bit about those. And excuse me, I'm going to jump through a lot of slides here. I have got quite a few slides, but I'm going to make the slideshow available, and I think Lynn has it as well to send out after this call. So if you want to go through it in a little bit more depth, feel free. You'll have this slideshow. But really the three types of long-term care solutions, or four maybe. You have your traditional long-term care, which I know many of you are familiar with, that you pay a monthly premium, gives you a stated benefit for long-term care. And that monthly premium may increase over time, but it really is the biggest bang for your buck, right? You can pay a reasonable amount of monthly premium and get a fantastic benefit when that person needs to file a claim. And then you have life insurance-based solutions, a hybrid, which I'll call a rider on life insurance, right, where you buy a life insurance policy. Maybe you buy a $500,000 life insurance policy, and you can add a rider, which allows you to use some of that death benefit for long-term care. And I like to think of that really as a transition policy. So you buy a life insurance policy where you're somewhat young. You need that death benefit protection for your family. You maybe have a mortgage, you have kids at home, and so you need that life insurance coverage should something happen to you to protect your family. And you add this rider for long-term care, and it's a minimal cost to add that rider. And as you age and your kids are out of the house, your mortgage is paid off, you still have this life insurance benefit. And so because you've added that rider, you've now transitioned the benefit from a protection for your death and protecting your family as a death benefit. You transition it to using that death benefit for long-term care. And so that's really how I think of those sort of products. And then you have the SecureCare type of policy, which I'll talk about today, which is what they call an asset-based long-term care product. The asset-based long-term care product is also based on a life insurance chassis. And we use life insurance to give it some guarantees, but it is kind of a blend between a traditional policy and that hybrid that has a long-term care rider on life insurance. So it is a blend between the two. It takes the guarantees of life insurance, but then also has increased benefit for long-term care. You can add inflation riders, and the bulk of the benefit is for long-term care. And I'll dig into exactly how our product works among some of the others. I will just briefly mention a few statistics here. I know many of you know the need for long-term care. You see here we've pulled out a few from some government reporting that about 52% of folks will need long-term care. many of you are familiar with the statistic. If you live to at least age 65, you have a 70% chance of needing long-term care. Average lifetime cost across the board is about $172,000 for formal care. We know that the cost of informal care takes it to about $300,000 plus. And informal care, I'll define as an unlicensed caregiver. So this might be, a neighbor, a friend, or someone that is just not licensed, not a nurse that you hire to come into your home to provide care. The growth of these markets has been pretty incredible. The individual life products, I mentioned that hybrid life insurance with a long-term care rider, has been about at 13 million or so over the, 13 billion in 2012, and grown significantly to about 14 billion in 2018. The asset-based products, that SecureCare is an asset-based product. Those that in 2012 were about $2.5 billion and have grown double to about $4 billion in 2018. These continue to grow. The asset-based products, I think, will continue to make up a bigger and bigger part of the long-term care planning strategy. And I'll give an example of a client that is a good fit for this type of product, but it tends to make more and more sense as a long-term care planning tool. And I'm going to give an example here of how SecureCare works and an ideal client. So, your traditional product, you think of someone that maybe has life insurance protection. They've got a good income for retirement, but they don't have long-term care protection. And not having long-term care protection, should they have a long-term care need in life, would significantly harm their longevity, right? They may burn through all their assets. They may end up on Medicaid. And so not having long-term care protection is a significant risk. But they have limited assets, right? And so, but they do have enough income that they could afford a long-term care. That's the person I think of when I think of traditional long-term care solution. This asset-based solution is someone that maybe has a little bit more assets. And I think of maybe let's say a 60-year-old female that's worked for, we'll call it state government her whole life. So she's worked for state government, had a good career in the government, and is walking away with a great pension. And this pension is enough to cover her income, and so her income is set, right? Along with her income and that pension, she's been able to save $500,000 in the bank. And so she has $500,000 in the bank, and maybe a couple other assets that she's accumulated. As she goes into retirement, her biggest risk is a long-term care risk. She's got the pension that's going to cover her income, and as we know from statistics and from data, for someone that is prepared for retirement from an income standpoint, the biggest risk to a successful retirement is healthcare costs and long-term care costs in retirement. That is their biggest risk in an unplanned healthcare event, right? And so there is a need to plan for that. And as a financial advisor and agent, as you're talking to those folks, what are we allocating to mitigate that risk? Well, if we don't have a plan, we're allocating everything we have, right? We're allocating our assets in the bank. That income is what she needs to live on, and that's not going to change. We see that even as people age, they still need that income for living expenses, right? And they've got other obligations. And so the $500,000 that she has in the bank is what's going to be allocated for her care. That $500,000 may be enough. It may not, right, if she has a significant care need. And so why not leverage the assets that she has, leverage the money in the bank in a better position to better position her portfolio to mitigate this risk. And so we're going to take a portion of it, right? She has $500,000 in the bank. We're going to reallocate. We're not really spending premium. We're shuffling it around. We're reallocating a fifth of it, $100,000 as a single premium. And that creates a death benefit. And this is illustrated in a bucket method. Many of you have probably seen this type of illustration with these products. But it creates initially a death benefit, and that is that first bucket you see here labeled acceleration for long-term care benefits. So that death benefit, it's a small increase. It's illustrated here as day one, $111,767. That would be the death benefit that her family walked away with should she need care, should she pass away and not need care. And so that death benefit, it's not really meant to be a protection product like other life insurance. But that death benefit is intended to be really a return of premium, a return of investment plus a little bit, so that she knows she's invested in this product. If she dies and doesn't use it for what she intended, her family will get something back. She will get something back to her estate, a little bit more than she invested into it. This has a 3% inflation rider, a 3% compound inflation rider, so it does grow with time. You see age 80 benefits are illustrated as well. So by age 80, this initial bucket grows to 190. Now, her death benefit is going to stay the same. It'll stay the 111. But we're accelerating this growing bucket of money. And so this initial benefit by age 80 grows to 190. And if she were to file a claim at age 80, the payout is illustrated in this final bucket as $7,811 on a monthly basis. And we're going to burn through this initial bucket first. And once we've exceeded the $111,000, the death benefit is gone. And so we burn through our death benefit first, and then we start to pay out of an attached long-term care policy. So this is really like a base small life insurance policy with an attached traditional policy. And so that second bucket represents the attached traditional policy where we continue to pay the $7,811. In this example, it would last for 6 years. The base life insurance policy would last for 2 years. The attached LTC policy would last for 4 years for a total of 6. If she were to exhaust the entire benefit at age 80, from 80 to 86, it would pay out just over $600,000. And so from a total portfolio view, we've taken a portion of her assets, $100,000. We've turned that 100 into $600,000 of long-term care protection. Now we have $600,000 of long-term care protection at her age 80, assuming she files a claim at 80 or beyond. Some would estimate for a female a long-term care claim in the mid-80s, maybe 84, 85, 86, 87. And so this risk is mitigated. Now she can invest that $400,000 differently than she might have. She can put some in annuity, she can put it in mutual funds, she can invest it a little more aggressively because her goal is to pass that money down to her kids. Or maybe she wants to use it as a vacation fund or what have you, but that frees up the rest of her assets to do something a little bit differently because we've been able to mitigate this health care risk, this long-term care risk a little bit more appropriately. So this is a phenomenal opportunity to leverage a little bit of the assets someone has to really enhance their portfolio and protect them for long-term care. Now, Securian's product, as Jeff mentioned earlier in the call, it is a cash benefit, and that is one of the ways we stand out in the market. Many of the products are reimbursement in nature, and so we're believers in an indemnity product for a couple of reasons, but the takeaway I would have for you is that it is as close to an income benefit as you can get within these type of solutions because it is cash. Once someone files for a claim and is approved, they get a monthly income. They can use that income however they see fit. And so it opens the door for a variety of care opportunities. Someone can pay a spouse should they want to pay a spouse or put that money in the bank if a spouse is providing care. Someone can pay one of their adult kids. Someone can pay a grandchild or a niece or nephew or neighbor to provide care, or pay for an informal caregiver, someone in the community that isn't a licensed nurse and maybe is more affordable than a licensed nurse would be to provide care, and so their money will last longer. And so it does open the door for unlicensed or non-licensed care, whereas a reimbursement solution. Yes.
John, I was just going to stop you. A question was kind of go before we go too far away from the benefit periods of 4 and 6. There's a couple other ones here I can save till the end, but this one just kind of was very, about the 6 year. And by the way, the point he's touching on right now, folks, too, is as far as cash or reimbursement. 75% of care happens in the home, and 3/4 of the time it's family and friends doing that care. I'm not a mathematician, but that's about 50% or higher of all care is not going to be reimbursed or not paid by a reimbursement contract. So if you only half your claims paid, buy a reimbursement plan. Anyways, cash is where it's at. This question here is on this. Okay, so why does Securian consider the 6-year benefit the sweet spot? Why not show benefits at age 85 or even 90 instead of the age 80 default? Why is the crossover point considered a critical factor in choosing the inflation factor? Did you follow that question? Okay.
I follow you. Yes, absolutely. No, that's a fantastic question. And me personally, when I sit down with a client or an advisor, I often will show benefits at 85 or 87. So that is my personal preference. I'm with you. I will often show benefits later in life. The 6-year benefit and the age 80 have become an industry standard. That's been an industry standard for over a decade. I'd say probably 2 decades. And so, that's just kind of the way it's been. But I'll tell you, as mortality's changing, mortality tables were adjusted a few years ago, and the age of mortality and morbidity is increasing. And so I think in the coming years you will see these ages that we show increase a bit to 85, maybe even later. But the age 80 that we show as a crossover has just kind of been an industry standard that's set out that companies use to compare to one another. And so everyone shows the same age. They show the 6-year benefit as a comparison point. But that is not to say that it is the best benefit. If you're talking about statistics, we know that the average length of care is about 4 years. If you look at care studies and cost of care studies, we see the average length of care is about 4 years. A nursing home stay, on average, is about 1.8 or 2 years. And so when looking at the risk and preparing a plan, 6-year is about the standard. I think the philosophy behind it is that we know the average care length is about 4 years, but we want to overplan in case our particular client has care that is longer than the average, right? Once you get into 5 years, 85% of claims are less than 5 years. Now, as an insurance company and as other insurance companies look at this, they want to price these products in a way that's beneficial to most clients, but also profitable for the insurance company, right? And so a 6-year benefit, it's inherent that some people are not going to get the full 6 years, right? And so some of that money stays with the insurance company. And so that does make these products profitable. And so you understand that it is the desire of the insurance company is to profit, but then also provide benefits for a bulk of the insured. And so keep that in mind as you make these plans and you design the products. But we can design anywhere, benefit periods anywhere from 2 to 7 years. And as Jeff was saying, 75% of folks or two-thirds of folks receive care at home or a combination of formal and informal care. And so one of the reasons I'm passionate and love the indemnity product is because it ensures not only that your care is flexible, but that you have the highest likelihood of getting most of the benefit out of the plan. In this example, if you have a $7,000 monthly benefit, but you're receiving care at home, and your cost is $5,000 a month, and you have a reimbursement plan, and you're using a qualified caregiver, you're going to get that $5,000 a month reimbursed. That's fine, but you're leaving $2,000 a month in the policy. And so as you're receiving that care, and you receive the care for 6 years, you've built up money in the policy, and so you're not going to exhaust the policy at 6 years. It might take you 7, 8, 9 years to fully reimburse everything out of the policy. And so a cash benefit not only gives you flexibility, it also gives you the opportunity to maximize the benefit each month. You don't have to have claimable expenses to get the full benefit, and so you have the highest likelihood of getting through all of the benefit in the benefit period that you specify. So another opportunity, and I've got an example I'll go through in a moment here that really highlights the power of that. But to get into a couple other additional product features, and thanks, Jeff, for that question. If any others pop up, please let me know.
Hey, there's a couple more here, but I know you said you wanted to be, John, there's a couple more, but again, I'm going to save some of these to the end because I think they can kind of be addressed at the end. So I'm just going to let you get rolling here so we can,
Sure.
get closer to 10:35, 10:40, and then we'll just open it up. So go ahead, John. Thanks.
Absolutely. So yeah, and I've shown a single premium option. So that single premium option, and again, for the sake of comparison, we often show a $100,000 reallocation into the plan. But we can do a single pay, a 5-pay, 10-pay, even a 7-pay, and 15-pay. So we have multiple options. Those can be paid annually. They can be paid monthly. So there are additional funding options. There's a reduced paid-up benefit for those multi-pay options. And it is guaranteed, and it is proportionate. So let's say you have a 10-pay, your client chooses a 10-pay, but after 5 pays, they say, you know what, I can't continue to pay this premium, or I'm satisfied with my benefits. I don't want to continue to pay. And so after 5 years, they stop paying on a 10-pay premium. They paid 50% of the premium, so they have a reduced paid-up benefit of 50% of the original benefit. And so that is that guaranteed reduced paid-up benefit. There's a return of premium. It is on a 5-year vested schedule. So at day one, you have 85% benefit. Should you cancel the contract, you'd get 85% of that premium back. That increases by 4% each year, so that after 5 years, you cancel the contract, the client gets 100% of that premium back. There's a minimum death benefit as well, and so I mentioned that as you burn through that initial base policy, you burn through your death benefit. But there is a residual or bonus death benefit that even once you burn through that initial benefit, once the client passes away, there is a 10% death benefit payable up to $10,000. And so generally it is going to be a $10,000 payment that the family will get once that client passes away, even if they've used all of their long-term care. We can design this around anywhere from a $50,000 base policy up to a $750,000 policy. So it can become pretty sizable with a 90-day calendar day elimination period. So that is 3 months, 90 calendar days from filing a claim, these benefits begin. I'm going to jump into a few concepts because I think these will help you kind of picture some clients and some opportunities to fund. But before I do that, there is a comparison I mentioned that I would go through. I'm going to walk through a couple of these slides here. Bear with me. I will mention the international benefits. So Securian does have some of the most robust international benefits with these types of plans. And we do pay 100% of the benefit internationally. So someone that is interested in retiring abroad, or maybe they're move to the U.S. but might move back home and buy the policy, they can retire abroad and file a claim internationally and get 100% of their benefit. Now, it is payable at 50% of their monthly maximum. So just be aware of that. If you were to design a 6-year plan, a 6-year benefit, like the example we went through, it would take 12 years to get the entire benefit because it pays at a rate of 50%. But it is cash. Someone could use informal caregivers abroad and receive up to that 50% benefit. Many of these policies with some of the other carriers in the market pay only the base policy and don't pay the entire benefit, the attached long-term care policy. But Securian does pay the entire benefit just at that rate of 50%. So in these cases, I would probably suggest that you design a shorter policy, a shorter benefit, maybe one that's 4 years or even 3 years, something a little shorter that they could have the likelihood of using up their entire benefit. So as I continue here, a couple of tax strategies. This is something that we get questions on quite often, is how is it viewed from a tax standpoint? And so I'm going to walk through this a little briefly, but if you have questions on it, feel free to ask at the end here. But Securian did design our product to have some tax deductibility. And we designed it so that as you pay premium, the long-term care premium of the policy is paid off the top. It's paid immediately, and then the remaining balance goes into the cash value. And so paying the long-term care premium separately from that premium allows it to be deductible to a point. And so there are a couple of opportunities to deduct some of this premium for an individual, and there's some opportunities for businesses as well that I'll touch on briefly. And we've got some great material and some worksheets to help you walk through what's deductible. But for an individual, let's say we have a $20,000 5-pay. We're going to pay $100,000 over 5 years, $20,000 a year. Depending on how you design this, and if you use an inflation rider, a majority of that cost will be for the long-term care. And so out of a $20,000 premium, you may have $5,000 that represents the life insurance and $15,000 that represents the long-term care. Well, out of that $15,000 that represents the long-term care, that might be deductible. Now, the IRS has set out age-based limitations on what is deductible, and you see that on the right hand of the screen here under number 2, that at attained age from 40 to 71 plus, you have the amounts in 2019 that they could deduct. So from 61 to 70, you see in 2019 they could deduct out of that LTC portion of their premium up to $4,220. And so that's the amount that they could deduct. Now, be aware that it is deducted as part of their medical cost deduction. And to get that medical cost deduction or medical expense deduction, they do have to meet up to or more than 10% of their adjusted gross income in medical costs and expenses. And so this $4,220 could be part of other medical expenses they have to get them to that 10% of their adjusted gross income that they'd be able to deduct. And so there is a limited opportunity to get that deduction because they have to meet that AGI limit, that 10% adjusted gross income. And so this talks about itemized deductions. I would fall under the itemized deduction for adjusted gross income. You might think to yourself there are limited folks that would have medical costs in the same year that they're applying for this policy. And if they have those medical costs, then there's probably concerns about them getting approved for the product. And and you're exactly right. There is a limited opportunity for an individual to take this deduction. But there is a great opportunity for businesses. And so if you work with small business owner, particularly S Corps and C Corps, S Corps or pass-through entities are similar to an individual in that they have the same deduction, they have the same age-based limit, but as a S Corp, as a business owner, it is an above-the-line deduction. And so it doesn't have to meet that 10% adjusted gross income requirement. They can deduct it right off the top of their current income. And so as an S Corp owner, if they're 61 to 70, they can take up to that $4,220 a month. It's above the line deduction. They deduct it right from their income. And so it's not the total premium. It is limited still by that age-based IRS limit, but it is an above-the-line deduction. So there is an opportunity there for S Corp owners. And here's an example. A corporation buys a 10-year policy, $10,000 a year, or a $100,000 SecureCare policy for the owner or key employees. The annual premium, again, is $10,000. The life insurance portion or face amount of that policy is $5,473. And the acceleration for long-term care, the extension, that's that attached LTC policy, plus the inflation, represent another about $4,000. And you see here at Tyrone's age, while he's 55 to 60, he can deduct up to $1,580 a year. So for 6 years, he deducts a total of $9,480. From 61 to 64, that deduction increases to $4,220, and for those remaining 4 years, he gets to deduct about $16,880. And so there is an opportunity as a small business owner to buy this policy and get some tax benefit. A bigger opportunity is your C Corps, your actual corporations. They get a bigger deduction. So the C Corp can deduct the entire premium as a business expense. And so in this example, we have a corporation that maybe buys for the owner or a group of key employees. In this example, it's $20,000 a year for 5 years. The business can deduct the entire $20,000 premium. And so that is a huge opportunity. The individual or policyholder or executive in this case only has to claim as income the amount that is the life insurance part of the policy. So in this case, the business spends $20,000 on the policy. They get to deduct it. Nancy, who's the executive in this example, that premium, $5,000 represents the life insurance. The other roughly $15,000 represents the long-term care part of the premium. She does not have to claim the $15,000 as income, only the $5,000 that represents the life insurance. And so big picture here, the business can deduct $20,000. The executive only claims a small portion of that as income. So it benefits both the business and Nancy to claim small amount as income, but also get this fantastic benefit. And we are seeing more and more corporations look at these plans as executive benefits for a small group of key employees added to whatever other executive benefits they offer in a package. And so this is becoming more and more of the conversation, I think, a key opportunity for you, especially if you work with small businesses. So I'm going to pause there, Jeff. You mentioned there's a couple other questions, so let's jump into those,
do have
questions.
some. I mean, I got about 6 or 7. Do you want to just try to answer those now, or are you kind of getting closer to the end, or?
I am. Yeah, let's jump into those, and if we still have time,
Okay.
we'll talk a little bit about
that way, we have some time. All right. Again, I've kind of tried to, for those of you listening, I've tried to answer a lot of these privately. I guess I've sifted through about 20 or 30 of these, so I'm down to about 6 or 7. I'm not sure about, so I'm going to let you try to answer. All right. I think I know this one too. Okay, this isn't a joint policy. I think they're probably talking about it's not a joint policy. And what about using qualified funds? I think you can use qualified funds,
Sure.
right, to put some money in to fund it with? Yeah. And you guys don't have a joint policy option, right?
We don't have a joint policy option. No, this is individually owned only.
Yep.
There is a couple's discount, and so simply being married or in a domestic partnership will give you a discount on premium. And both of those individuals don't have to apply. Just simply being married gives the discount. And it's a discount somewhere between 5 to 7, 8% off of premium, depending on the client's age.
Okay.
You can't fund this policy directly with qualified dollars. And so it can't be funded with qualified dollars. I know you're probably familiar with the One America plan that allows you to fund it with qualified dollars, and so that wouldn't work with this this policy. Now, you can fund it over time directly from that qualified source. So maybe you look at a 10-year pay or a 15-year pay and fund it over that 15-year period and take a less of a tax hit on those distributions from the qualified source. So that's what I would suggest in that case. That is similar to the One America design. For those of you that are familiar, they have a package that you fund a annuity essentially that pays the life policy over 20 years, and so you're spreading that tax hit over 20 years, but they kind of handle it as one bundled package. You could do that on your own from the qualified fund or from an annuity and fund this over maybe 10, 15 years. Great question.
Yeah, that works, I guess. So this one here, this is a double, and it's kind of interrupted here, so I'm going to try to read both parts. Assume she qualifies for LTC at age 70 after the policy is in force. Does she have $300,000 plus available? I think this is one of those slides you had back a little ways. Do you follow that question, or is that?
Yes, say that one more time. So assume she
So assume she qualifies for long-term care, goes on claim at age 60, and the policy's in force. Does she have $300,000 plus available? The answer, yes?
Yes. The answer is yes.
Okay.
So that day one benefit
Let's keep it to that.
Yes, that's available from day one. And there's a couple of ways to design it. If you don't choose inflation, that day one benefit is bigger. But the inflation causes that day one benefit to be smaller, but that $300,000 is available day one, and with inflation, if that's chosen, it grows over time.
Okay. Do you have any inflations that are less than 3%?
We don't. So it's a 3%
I didn't
simple.
think so.
Yep, 3% simple would be the smallest inflation, and the 3% simple is quite affordable.
Yeah, that probably equates to about 1.5 compound somewhere in there. So that's got to be affordable.
Yes.
Let's see what else I got here. Are a couple of ones here. I'm just not even sure quite how to answer these or how to. Just reading through some more. Bear with me, John. I'm sure I got them all.
Absolutely.
Okay, I did see one here. What are the plans' competitive edge, or even their, what makes them competitive over the other plans? For example, like the MoneyGuard, or that's rough. And I just want to. I'm going to pause, John. I'm going to try to just take a stab at this. Being again a long-term care person, you spoke about that cash benefit. And I guess when I talk Securian, because we do compare and contrast, John. As you know, we work with a couple of them, the One Americas, and we've done a handful of MoneyGuard and all this. I come back to that cash benefit. Being a long-term care benefit, I've written 610 long-term care policies in my life. I get claims, once a month. And invariably, they're always telling me, can I pay my daughter, my sister, my neighbor kid who's shoveling my walkway, or, mowing my lawn, or the church is bringing me meals. And, when you have a cash benefit, you spoke to this, it just allows people to recoup their premium dollars a lot quicker. In other words, when I sell insurance products, I want to help people. And so let's just say that Securian, devil's advocate, just for rough numbers, let's just say that they are maybe 10, 15% higher than maybe a One America. Well, I would rather see them dump 15% less premium into it on the front end so they can actually get the benefits when they need it. In other words, a $7,000 reimbursement benefit that you can't get to doesn't help you. But if a $5,000 cash benefit helps you because you get all of it. And so, you really, if you can't underestimate enough, to me that sweet spot for Securian here is the cash emphasis that this policy has. That is invariable. That's just invaluable come claim time. So that's just my 2 cents, John, unless there's some other competitive sweet spots that you have. Go ahead.
Yeah, no, I appreciate that, Jeff. And I pulled up a slide here, and at the bottom we've got a couple of companies you've got Lincoln, Mass Mutual, New York Life, One America, Pac Life that are reimbursement, and Securian and Nationwide that are cash. And you're exactly right. The cash opportunity can't be understated. But I will say, just from a pricing standpoint, that Securian, when we developed this product, and we've been in the market for about 2 years now, so we are the newest entrants to the market out of these choices. But when we entered the market, we decided we wanted this product in long-term care to be a staple part of our business, and so we priced it to grow significantly and grow quickly in the market. And so it is priced very competitively. When you look at Lincoln Money Guard, who's traditionally been one of the better priced products, we are right in line with Lincoln. We actually price better than them at many ages, particularly on men and women in that late 50s to late 60s sweet spot of where folks traditionally buy these products. We are one of the better priced products in the market. So not only are we cash, but we are better priced on those individuals, particularly with a single pay. So you'll see that we often are priced best on a single pay, whereas maybe a Nationwide or One America price better on those multi-pay options. And so just to kind of give you a sense of where we're priced and what our sweet spot is. Our average applicant is 61, a 61-year-old female with an $80,000 single pay is our average client, to kind of give you a sense of where we fall. But as Jeff mentioned, I'll pull up this slide, and this might be a little hard to read, but it kind of highlights, and this is a marketing piece. If you're interested, let Jeff know, and I'll send it out. But it talks about really the progressive nature of care. As we age, very few folks, if you look at statistics, very few folks have a stroke and need immediate round-the-clock care. Right? It is progressive in nature that as you age, you start to need more and more help, right? And that help begins with family. And at some point, you need help with your ADLs, eating, walking, transferring, getting it out of bed, continence, those things, and would qualify for this product. As soon as you qualify and families around you providing that care, with this cash policy, you should go ahead and file your claim because your goal is to use as much of the benefits as possible. And so this walks through kind of a progressive idea that maybe you get care at home informally for 2 years, then you have home health care from a licensed caretaker for 2 years, and then you go to a nursing home for 2 years. That makes up the 6 year. And of course, this is a 6-year example, but it highlights the power of cash in that while you're at home, all things being equal, a reimbursement and a cash policy, the 2 years at home, the cash policy pays the full benefit. You get almost $330,000, whereas that reimbursement doesn't give you anything in those first 2 years. And then as that continues at home from a licensed caretaker, you get your full benefit even if the cost doesn't meet the maximum monthly benefit. So you get $360 over those 2 years from your cash, whereas the reimbursement gives you about $83,000. To the point where over 6 years you've gotten $263,000 from your reimbursement policy, and that met your formal costs. But because this cash policy is income, and you're getting that income from day one as soon as you could possibly claim it, you were able to pull an income of $1 million over that 6-year period. And so that is significantly more from that cash policy because of the progressive nature of that care. Really to highlight Jeff's point.
I like that slide, John. Yeah, that's a powerful slide. I mean, that's extreme, showing extreme prejudice on it, but that's how it works. I mean, I can just tell you from my own experience, cash pays, reimbursement doesn't. So what you have is a client come claim time, that you're going to have unhappy clients. And to me, if I could redo all my long-term care plans I ever sold, because I sold long enough 20 years ago when there wasn't cash plans, and so I have a handful of my plans, half of them, 2/3 of them are these reimbursement nightmares that I'm always fighting with claims on them. I'd rather just give them a check and pay who they want. It's just so much easier. Now if these are available, I wouldn't sell a reimbursement plan anymore. Having the experience that I have in this market, you just don't want people to not be able to pay their daughter, spouse, neighbor, neighbor kid, whatever. You just want them to have the most flexibility as possible come claim time. John,
Yes.
I have one more question here. I mean, this is kind of like a, maybe a catch-all, and this is something that, myself. So as far as getting started, and I would suggest, folks, that if you are looking at the hybrids and you're maybe shopping and comparing them, I mean, John, give us a good place to maybe call where we can, get access to you, or our brokers can maybe call a helpline to compare, contrast a case. Certainly they can call Golden Care here. We'll try to help you. We talk to the marketers over there. Is there another kind of line, or like a broker line where they can call and get comparisons? Or
Absolutely. And I'll tell you what, let me, I will pull up a sheet here that will give you our contact, but you can absolutely call myself, and I'll give you my number. You can call. I've got an internal partner named Fred Sherman. Fred is fantastic, and he's a great resource. So Fred would be able to answer any questions you have. But we also do have a customer solutions line that you can call and get quotes, answer questions, any questions you have. So I'm going to pull that information, and this is a sheet that I can send out after the call. But if you want to jot down my phone number, Jon.Thomas at Securian.com.
Go ahead and write those numbers down if you have. I call them myself, and they're fantastic. I mean, I think I just talked to Lisa the other day too, John. Is she part of that team? And
she sure is. Yep.
Yeah, she got me stuff immediately. So, and I'm not going to claim to be an expert in this. I visit with you guys, and I strongly suggest you write these numbers down. If you're thinking about selling a hybrid, if you are selling hybrids and haven't sold Securian yet, let them do some numbers for you. Let them do some comparisons, because I think you're doing your client a little better shake if you look at the Securian plan. I have one more too here. This does come up, John. So do they have access to pricing the portal before you're appointed? It seems like I had a little trouble with this too. You don't have to be appointed naturally to be quoting me. So how do I get access to numbers without yet being appointed?
Yeah, great question. You can sign up on our website, and there is a process through which you have to enter your information and sign up, and 24 hours later we'll email you a login and password to get access to our software to be able to run those quotes. So you can run quotes before you're appointed. I tell you what, reach out to Fred or myself, and we'll walk you through getting set up so that you can run numbers prior to being appointed.
Okay, yeah. And you know what? I'm jotting your number down myself on my contact sheet here, John. I already had Fred's and the other ones over there, so I'm putting your number down because I do get them, and I appreciate that. It's already been like 50 minutes here, so I feel like I'm just going to go ahead and kind of wrap up. Maybe leave these numbers up here for a little bit, just for a couple minutes for people to get them down. And I think we've come to the end of our questions. Actually, I don't see any new ones. Yeah. So listen, folks, I know there's always going to be more questions, and we typically try to keep these 45 minutes or so we're a couple minutes over that. So I just want to thank you folks for coming on board today. Big turnout today, which we like to see. Great job, John. Thanks for sharing all the stuff. And these products, and I think you had a slide on this, John. 5-6 years ago, there was 4 long-term care plans, traditional long-term care, for every 1 hybrid. Well, now we've switched around to where it's 5 to 1 the other way. So this is just a prevalent part of our industry. It's here to stay, and these plans are a great fit in many situations. So, if you are trying to just get into these more, lean on John and Fred there, and they'll help you. They'll help you write your first couple cases, kind of get you started. Call Golden Care at the marketing office. We can offer you some support as well, but we want to help you write these things. So, again, I just want to thank you for coming on board today. Their number today, I'll give you Golden Care's number too if you just want to call and maybe get some supplies sent to them, or we do have some of the PDFs of the stuff we can share with you. 800-842-7799 is Golden Care's number. I'll say it one more time, 800-842-7799. And I want to thank everyone for coming on board. We are starting to kind of lose some folks. So, John, if you want to have any other closing statements, go ahead.
Yeah, thank you, Jeff. I will mention just briefly, I didn't talk about underwriting, but it is a simplified underwriting process. And so our goal is to underwrite these products within a matter of a week to 2. And so, you know, it is a fantastic opportunity, not only from the product standpoint, but from an underwriting standpoint to get through underwriting quickly from application to getting paid. And so there's a good opportunity there. If you have a certain client you want to run by our underwriting team, check out the upper right-hand corner, SecureCare Quick Quote at Securian.com. So jot that down. Feel free to send an email with just a brief description of your client to see if it'd be a good person to apply, or if it's something that we immediately can tell you, no, they'd be declined because of that certain medical issue. So that's great to utilize before going down this path with a particular client. But also, I do want to thank everybody. I appreciate everybody hanging in there with us. And Jeff, Lynn, and everybody at Golden Care again. Tom, thanks for the invitation and having me on today.
Okay. Thanks, folks, for coming on board. And again, good luck selling out there. Give us a call if we can help. Thanks now.